Hello everybody and welcome to our Module 6 video covering Part 1 of the topic of equity. So first of all, let's talk about an overview of equity. When we talk about equity from a company's perspective, we're talking about ownership shares in the company, basically stock. If you have a corporation, it would be stock. You could also have a sole proprietorship where it's just capital or equity. The idea here is that when you have a company and you need financing, there are two main ways to obtain that financing. You could either have owners invest money into the company and share in the risks and rewards of the company, or you could borrow money, most commonly through bonds or notes payable. So with equity, we have, again, equity financing. Bonds would be debt financing. Now, again, with equity here, we're having the owners, each individual owner that buys stock, they're contributing that capital into the company and they're sharing in the risk and the rewards of that company. They own the company, technically, but when we talk about a corporation, they're generally not going to be directly controlling the company because many of those stockholders, I could go out and buy one share of Coca-Cola or Pepsi-Cola or, GMC, any of the companies, the large companies. That one share is not going to entitle me to be able to control the company. So instead, when you buy shares of stock, generally you have indirect control by electing your board of directors or electing the directors that make up the board of directors, and they represent your ownership interests. That's generally how that works. The more shares of stock you own, the more voting shares specifically, and that's another topic altogether, but the more voting shares you have specifically, the more power you have. When you get to the point where you own more than 50% of the company, you have more than 50% of the say in who's going to be the board of directors, and they are now representing essentially you, mainly you. And if the company, the CEO, the officers are doing something you don't like, you can have the board of directors replace them, or again, you just have more of a say in the company. But if you just own a few shares here and there, you're not going to have a whole lot of control. So when we talk about this from an accounting perspective and a financial statement perspective, we're going to talk about the different subsections of equity. So we have what we generally think of with equity. It's the paid-in capital or contributed capital. This is the stock itself, the common stock. Some companies may have preferred stock. And then we'll see something called additional paid-in capital, sometimes called in excess of par. We also have the retained earnings, which is also known as the earned capital instead of paid in. This is the money the company has earned throughout its life that it has retained in the company as opposed to distributing it out in the form of a dividend, which was next. The dividends of the company, sometimes called withdrawals if it's a sole proprietorship, this is the amount of money that's been distributed. It's the earnings that are distributed to the investors as part of their return, as opposed to retaining it in the company to grow and expand. Now we also have another topic, another subsection called accumulated other comprehensive income. So I want to go back to retained earnings here. We know that we have, from previous chapters, we know that net income closes out eventually to retained earnings. The revenues and the expenses close out to retained earnings, and that carries forward the balance. So it's an accumulation of all the net income that the company has earned. Accumulated other comprehensive income is the same idea, but it's for a special type of income called other comprehensive income. And actually what this is it's not just your regular income. It's the special type of income, and we'll see it a little bit later on. It's certain gains and losses that haven't been realized at this point, but nonetheless they're important to explain to the investors or make transparent to the investors. And then we have something called treasury stock that we'll see a little bit later. This is basically when the company itself is buying back shares of itself from the open market. Now, if the company did that to any other company, if they went out and bought shares of a competitor for whatever reason, that would just be an investment. It'd be an asset, it'd be an investment. When they buy shares of their own stock, that's not an asset, that's not an investment. Instead, it's a reduction in the owner's equity because now one of the owners no longer has that stock. The company has pulled it back. It's kind of the opposite of when they issued the stock to begin with. It's going out to the owners. Now they're pulling it back. Now we also have a few, again, we talked about the different classes of stock just a bit ago, common versus preferred. So we're also going to talk about some options that we would have for preferred stock specifically. And we'll talk about the callable provision, which is actually the company's benefit. They can buy that stock back early, kind of an early payment, and generally they would do that to refinance. The convertible privilege is generally a benefit of the owner themselves, the investor themselves. They have the right, if they wish, to convert that preferred stock to a set number of shares of common stock. So what we'll see here is the benefit of being preferred stock is that you have a higher likelihood of getting your dividends. You're going to get preference over the common stock for your dividends. So that could be a good thing, but the bad thing about that is it's just like a bond. It's similar to a bond where generally the maximum you'll get is that preferred dividend statement, that percentage, that amount. So if the company's doing really well, then you'll get your preferred dividends, but that's it. If the company has huge dividends they're issuing in general, most of that's going to go to the common stockholders. You're limited to the amount that's been stated. So a preferred stockholder may be willing to give up some of the safety of their preferred stock dividends in exchange for more control through the common stock side, as well as the potential for more dividends. Giving up the safety of the preferred dividends for the possibility of bigger common stock dividends. Now, the returns on investments. We're talking about an owner, a stockholder. Why would they invest in the company? And generally the reason is they want a return. One of two types of returns, or possibly both. They may be looking for regular dividends, which are short-term returns. You get that generally every quarter, every 6 months, every year. But the thing is, there's no guarantee that you'll get dividends. It's not like interest for a bond where you're contractually entitled to it. With dividends, it's up to the board of directors to declare the dividend. If the company's having a bad year, they may not declare a dividend. The other thing, of course, from a company's perspective, it is not an expense like interest is for bonds. Therefore, it's not tax deductible. But again, from an investor's perspective, this is a return on their investment, one of the returns on their investment. The other return is more long-term. It's the gain in the value of the stock by the time they cash it in. So that's the other return. Now again, it's not like a bond. There's not a set date where that has to be paid off. It's completely up to the investor as to when they want to cash that in and sell it to whoever is willing to buy it on the open market. So when we talk about stock, we generally talk about the multiple classes of stock. We've covered a little bit to this at this point. We have common stock, which is required. That's your base level of stock. Then we have preferred stock, which again, it's not going to be found in 100% of the companies. Fewer companies have this type of stock. By the way, there are different names for these in some companies as well. These are just the more common names. Again, they can also issue multiple classes of stock. It's all based on what has been determined in the corporate charter initially and how they change things throughout the life of that company. So we talked about the power of common stockholders. They have the right to vote in the new board of directors, and they can also vote on issues that require investor voting. From time to time, certain things are brought up. If they're going to sell the company overall, if they're looking at some of those offers, and there are just various things that come up that may require entire voters to get involved. If they wish to. They don't have to, but if they wish to vote. Here is an example of a statement of changes in owner's equity. It's a pretty basic one. Now we have the different classes here. Common stock. We're going to see additional paid-in capital and what that means here in just a bit. Additional paid-in capital in excess of par specifically. We have retained earnings we've talked about. And then we have treasury stock, which we will talk about. So common stock, we have the beginning balances. What was issued initially? What were the beginning balances carrying over from last year? Common stock had $100,000, which was 100,000 shares at a $1 par value. Now this next column, additional paid-in capital in excess of par, this tells us that apparently they sold those shares, at least on average, at $3 per share. 100,000 times 3, so the total of this makes up 300,000. Now that the amount above and beyond par goes into this additional paid-in capital in excess of par. Now they issued 200,000 more shares at the same par value and apparently the same price. So another 200,000 here in common stock and another 400,000 here in additional paid-in capital in excess of par. That gives us our ending balances for those two. Retained earnings is your beginning balance plus net income minus any dividends, if any, were paid. Now, I will say later on that there is also one potential additional adjustment to retained earnings that relates to treasury stock, and we'll see that a little bit later. If they buy treasury stock at a certain price and sell it at what appears to be a loss, that could be a negative hit to retained earnings. We'll get into that in a little more detail later. Treasury stock, this is the stock that the company has bought back of their own company. They had nothing like that to begin with, but then they bought back $50,000 of their stock, and then apparently they sold it again by the end of the year. So in the end, it's a zero balance. So that's what we have over here. So we talked about preferred stock a little bit. Now, the preference here, there are actually two preferences. Dividend distribution, first of all, and asset distribution upon liquidation if the company decides to liquidate. Now, the key thing to remember, though, this is still stock. This is still owners. The creditors always have to come first. They're the ones taking on the biggest risk, and they get their money first. They have no control over the company, so they get their money first, their interest, and then their principal. So the preference here is after the bondholders are paid. Now we're talking dividends. The preference is that the preferred stock will get dividends ahead of common stockholders, but that's still not a guarantee because dividends may not be issued at all. And then again, when the assets are distributed upon liquidation, the creditors get their money first, and then what's left goes to preferred stockholders up to the amount they're entitled to, and then after that it goes to common shareholders. Now, the drawback to the preferred stock generally is that there is no voting power. They're still an owner, but they're kind of a hybrid between an owner and a creditor. They get some of the benefits of both, some of the risks of both. The loss of voting power is more akin to a creditor. They don't have voting power either. Here we have some of the preferences, or some of the options that preferred stock can have, some of the characteristics. We have cumulative versus non-cumulative preferred stock, and this goes to whether or not they get any dividends if the company did not pay dividends that period. If it's non-cumulative, then what that basically means is if the company did not declare enough dividends for them to get whatever their stated percentage is, then they're just not going to get it that year or ever. That year is gone. Maybe next year they'll get next year's dividends, but this year's amount is gone. Cumulative, on the other hand, let's say this was a $100 preferred stock with a 10% stated dividend rate. That basically means they kind of expect for every share of stock they have to get a $10 dividend. No guarantee, but that's just kind of the expectation. So let's say it's cumulative, and this year no dividends are declared. So that $10 that this stockholder would have received is kind of put on the books, and we keep track of it. And then next year, let's say the company pays a lot of dividends. With cumulative, what that would basically mean is first they get their back dividends, sometimes called dividends in arrears, and then they get that current year's dividends. And then if anything else is left, it goes to the common shareholder. Now, of course, even with cumulative, if the company goes the next 10 years and doesn't pay a dividend at all, then they go out of business, you're just out of luck. You don't get any of that dividend. Participating versus non-participating. So let's say that it's non-participating. By the way, most preferred stock is cumulative because otherwise they're losing out on their basic benefit. But most preferred stock is also non-participating. And what that basically means is they're capped at whatever their stated dividend percentage is. Maybe it's a 10% dividend. That's all they're ever going to get that year, and that's it. If the company pays out really large dividends one year, the preferred shareholders will get their 10%, and then all of the other dividends, which could be huge, sometimes called a windfall dividend, they would go to the common shareholders. So on the other hand, let's say this preferred stock is participating. What that would basically mean is the preferred stock gets up to their share, their 10%, then the common stockholders get up to the same amount, and then anything that's left would be shared equally between the two groups. So they get the best of both worlds. They get low risk, and they get the potential for high reward. Again, most preferred stock is not participating because that would be a serious issue to common shareholders. It would really put them in a very bad situation. They have all the risk and they don't get all the reward. So that's the problem with that. So let's go back to that par value that I talked about. We talked about additional paid-in capital in excess of par. This is generally just a nominal value per share, and it depends on the state the company is incorporated in, where they're operating out of. Some states require a par value, other states do not. It's one of those things that had more of a historical value, and it's kind of faded away over time. It's important to understand this is not the issue price. For common stock, generally this is a very small figure, usually a round figure like 1 cent, 10 cents, maybe $1. And again, the issue price virtually always is going to be above par. It wouldn't make sense for it to be under par. So it would always be over par for common stock. Now, the term par value is very important for bonds. We talked about that in an earlier chapter. And it's also important for preferred stock because the interest for bonds and the dividends for preferred stock, they're generally based on a percentage of par. So you need to know what that par is to be able to determine the interest or preferred dividends. But for common stock, there's just really little true accounting purpose for it other than to add a little bit of complexity to our journal entries. But the reason it still exists in certain states is that it's a kind of a guaranteed amount that'll be returned to every share of common stock upon liquidation, assuming the value exists even. Again, the creditors always get their money first, and anything that's left, the whole goal is that the common stockholders will at least get this. It's referred to as legal capital. That's another term for it. The other thing about this, the other benefit this has, is that it's the amount of capital that's supposed to be retained in the company. They can't pay it out in the form of a dividend, and this keeps your capital account or your equity account overall to at some minimum level to try to protect creditors in case of default. Creditors want to make sure that the board of directors is not paying out all the money to dividends to the investors and then knowing full well that a loss is coming up the next few years, and then the company's left with nothing to pay the creditors off. this is an attempt to prevent against that. It doesn't really work all that well, but again, historically, that's been the purpose of it. Now, when the stock is issued, any portion of that price, the issue price above par value, assuming it has par value, goes into that additional paid-in capital account. Of course, the par value itself goes into the common stock account. So let's say that we have 100,000 shares of par value stock issued at $3 per share, but it had a $1 per share par value. We would debit cash for the entire 300,000. We would credit common stock for just the 100,000, $1 times 100,000 shares, and the other $2 times 100,000 shares would go to a credit to additional paid-in capital. They're both equity accounts. They both get increased by credit. We could have a simpler situation where we have 100,000 shares of stock issued at $3 per share with no par value. That's simply a debit to cash for 300,000 and a credit to common stock for 300,000. So that sets the stage for what we're going to be covering in part 2. This is the end of part 1. We've covered the basic concepts, some of the journal entries. So I will talk to you again in part 2 as we continue on into the topic of equity. Thanks for your time.